The Indian Banks Association and leading bankers in the country have mooted a very important idea. They want to create a bad bank which can take off the bad assets that they've already provided for, create an ARC which will accumulate all these bad assets, become the owner of these assets, and then sell it through a professionally run asset management company. Now, how successful can this be? First, let us hear the State Bank of India chairman who mooted this idea.
Once the approach and a consensus emerges between all the banks, then only next moves regarding whether we need to take some regulatory dispensation or do we need some support from the government, whether government support will come, not come. All these are the open issues as of now. Of course, we will need investor. So the issue is around that if today an asset has to be sold, then the buyer also has to go to 15 different people. But if we come together and consolidate, even the buyer will have to deal with one entity and not 15. So that is the whole idea. But ultimately, the funding for funding or resolution, whatever is the current mechanism, more or less that mechanism would remain. So these are some initial thoughts at IBA level and by many members in IBA. We believe that this is the right time where a structure on the lines of bad bank, it can be worked out because the provisions on the existing NPAs, most of the banks are holding very high level of provision. So a bad bank 3 years ago was not feasible because the provisions were inadequate. So at least today we have the adequate provisions and net book value is hardly 10 to 15% of the gross NPA. And I'm talking about the accounts which are under multiple banking or consortium banking. I'm not talking about retail or smaller accounts. So a consolidation of all these assets, there is a thinking and there is a discussion that it may be the time when this idea can be given shape to, but still it is in the consultation stage at IB level.
Well, that's the State Bank of India chairman. Joining me now to discuss this idea are Professor of Finance at SPJ Institute, Ananth Narayan, and legal luminaries Bahram Vakil of AZB and Partners and Cyril Shroff of Cyril, Amarchand, Mangaldas. Gentlemen, thank you very much for joining me. Ananth, to you. First of all, is it a good idea? Secondly, if you can tell us one other example internationally which we can look to modeling our bad bank.
Latha, I think it's an excellent idea. So look, what is the objective? The objective is to get our financial services sector ready to fund relief and growth in this country again. Let's start with the first realization. At the moment, the financial sector is in a very weak shape. It cannot fund growth or relief as things stand. Now, how do you do that? You know, Arvind Subramaniam talked about those 4 R's, right? Recognition of bad assets, realization or recovery of those bad assets, recapitalization, and then reforms. A bad bank becomes very useful for the first 2, which is, the recognition as well as the recovery of that bad loans. Now, first of all, the scale of the problem. Even before COVID-19, the official numbers were 9.3% of bank assets were already non-performing assets, gross non-performing. Actual numbers, if you remove the forbearance on medium enterprises and on real estate, and if you take into account NBFCs, was probably more like 10-12% of overall advances. That's an enormous number. Banks plus NBFCs have about 140 lakh crores of loans. We're talking about 12 to 14 lakh crores of a problem, which is enormous to start with. Which is why, to start with, you need government intervention. Expecting private counterparties to provide this capital might be a tough one. To your second question, Latha, on what country could be a model for us to use. One country I specifically like is Malaysia after the Asian crisis, where they precisely used what I mentioned, which is government's own money via sovereign wealth fund to create an AIF, an alternate investment fund, AMC, called Dana Harta. What this entity did was, it was capitalized, by the way, exactly the way we recapitalize our public sector banks through decap bonds. This particular entity absorbed all the bad loans from the banking sector. And there were enormous bad loans there. They did it at a fair price, They ran for a time-bound program, ensured recovery, and in fact gave upside back to the original institutions which sold those bad loans. This allowed quarantining of the bad loans, at the same time allowed for recapitalization and reform of the banking system. It worked like a charm in the case of Malaysia. Some other countries didn't have such a great experience. Malaysia did have a good experience.
Come back to you to check out, what are the lessons we should specifically learn from Malaysia. But let me come to Bahram. Bahram, you were one of the moving force behind the bankruptcy code. It's probably just about settling down. That's 29A has been settled and all that. Would you want another experiment?
Thanks a lot, Latha. I think, I completely agree with what Ananth has said, that, the size of the problem is so big that to have as many tools in the box as possible will be very helpful. The numbers were pretty bad pre-COVID. So imagine now when you add to COVID and some particular sectors, as we have seen worldwide, airlines, hospitality, retail. So unfortunately, looks like these numbers are going to go up. So I think that we need different mechanisms. And so it's a welcome move. The issue is only that it has to be structured very carefully, and we should look at, there are lots of models, several countries. So I think if Malaysia suits us the best, we have to look carefully at a model which works for us and achieves the purpose.
Fair enough. Okay, I will come to you for any suggestions on model after I ask Ananth how the assets were bought in Malaysia, for instance. Cyril Shroff joins us as well. Cyril, first up, I want to ask you, if we go by this elementary, blueprint that Ananth has drawn of a bad bank that buys up assets at some price which the AMC decides, some market price, do we have to change a lot of other regulations? Is this going to be, even for the IBC, we had to change so many things, RBI Act, Banking Regulation Act, etc. Is this going to be a legal nightmare as well?
So I think my response, firstly, I'd like to agree with what Ananth Narayan has said. I think the time for the bad bank has come more than ever before. And I think it's important to structure it correctly, properly as a public-private partnership. Once you've accepted that public-private partnership as a thesis for how it will work, and you're going to give this entity sufficient commercial freedom to function freely and take commercial decisions, then I think you will need to have a number of related and cognate relaxations or dispensations given, including such as the ability of some of the banks to hold a stake in the AMC or the ARC. You will need to have guidelines in relation to with what values the asset will be transferred, book value, or will it have to run through an auction process? So an auction process would make it quite problematic, because again it will defeat the whole purpose. I think you will need to have a framework also on ongoing how the asset is resolved as well. So, answer to your question, will a number of legal and regulatory changes be required? Yes, but I don't want to overstate the problem. I think they can be easily identified and quickly done. It's not that complicated, but yes, changes will be necessary if you want to make this entity effective and impactful.
Well, all three of our experts have agreed that bad bank is a good idea. That is very important. And personally, I would think it would also mean that India is very serious about financial sector reforms, and that itself might bring a lot of goodwill and money into perhaps a bad bank investment itself and other investments in financial sector. We have to take a quick break since we have agreed on the basics that it's a good idea to go ahead with. Let me pose some more problems that it might arise and how to fashion it. All those questions after this break. We are back in a jiffy. Welcome back. The Indian Banks Association and key bankers in India are mooting the idea of a bad bank to hive off the assets they have anyway already provided for. I want to put one thing on the table. The banks are not going to make any money if these are hived off because these bad assets are provided for. The reason why they want to hive it off is that it goes under one entity and therefore selling it can become easier, but it's very preliminary. Now, Ananth, I've been speaking with Ananth Narayan, the professor of finance, and leading legal luminaries, Bahram Vakil and Cyril Shroff. Ananth, my big fear is, how do these sales happen? There is so much risk aversion among bankers. Can the Indian bad bank be designed in a way that this risk aversion doesn't come in the way? Whatever price you state, there can always be a CAG or, an opposition PIL, which says that you are selling it too cheap.
No, very true, Latha. So let me go back to the Malaysia example and tell you how they managed the entire process. There are lots of issues to be handled here in the transfer of assets. Okay. What Malaysia did was the following. This Danaharta I spoke of was entirely funded by the Sovereign Wealth Fund, Khazana.
Yeah.
It was manned by professional experts, including foreign experts. While the entity was domestic, they brought in a lot of experts. These experts went through every single outstanding NPA beyond a certain level, beyond a certain notional threshold. And they gave a price for it. So let's say for a loan of 100 ringgit, they said it's a 40 ringgit bid. I'll only buy it at 40. Now, the selling institution was free to say, I will not sell. 40 is too low, I will not sell.
Okay.
But if you did that, you had to mark it down to 40 or below, which means you had to provide that it is only worth 40. On the other hand, if you gave it at 40, and Danaharta, by the way, had a time-bound program, they had to wind down the program in 5 years' time. If Danaharta actually recovered 70 out of the same 40 ringgit loan, therefore 30 extra, 80% of that 30 went back to the original selling institution.
Okay.
Which means there was a link on the profit sharing to the original selling institution. This was a huge incentive to get the selling institution to sell without fear that it's being shortchanged, that it will always get back the money. But very quickly, Latha, a couple of other things. It's not enough if you create a bad bank and absorb this. One, of course, you have to do resolutions.
Yeah.
If all the bad loans are in one entity, particularly owned by the government, it's much easier to do the resolutions, including if you have to change laws. By the way, Malaysia changed a lot of laws to get the recovery or reinstatement of the company done. Second, you have to do reforms alongside. Otherwise, it becomes good money after bad money. This is after all taxpayer money going in. So things like PJIMR reforms, governance reforms, market reforms have to go alongside. Otherwise, the same cycle will repeat all over again.
Oh, absolutely. I mean, I take your moral hazard point completely, Ananth. It will not only be for public sector. You can even forgive it for public sector because public sector assets are being sold by the government, whatever. But, there will also be private sector loans over there. And the moral hazard that you are actually bailing out bad loans created by private sector will definitely be made. But I am worried about another moral hazard. Bahram, we had this fear that even in the NCLT IBC process, the promoter himself was coming, and then we had all these related party and 29A, changes, so that you kept the promoter out. Now, would not even in the bad bank this fear come, that the promoter comes in the guise of another company, or he himself comes and buys his company at, 20 cents to the dollar?
That's a very good question, Latha. I think that is a hazard that has to be looked at. But I think the crux, as all three of us have said, is that the transfer has to be as close to market price as possible. So that in large measure takes away from this moral hazard. So the real finesse will be in finding a mechanism which works in a timely manner. Because one of the easiest ways would be, again, you run an auction process and this AIF is just one of the bidders, but maybe that will be too time consuming. So you would have to find a way that the transfer is as close to market price as possible. And the second key issue, again, I think has already been mentioned, is that the AMC should be run by well-known, well-reputed, neutral professionals. That is the crux, so that you maximize value in round two. And then if a promoter, because this is pre-IBC, this is actually nothing to do with IBC. So just like you have pre-IBC bilateral negotiations, some of the power projects you saw, so it will happen. You will have to live with that. But in the situation we are in, I think it's a sensible way forward. But again, I must reiterate, and power, which will be a big chunk of these assets, without the reforms in the power sector itself, it's not going to help much. So that's a really crucial point, that this is a very good first step, but there are other steps that you have to follow.
Anand's point that this cannot come singly, we should have other reforms. Cyril, I mean, you may have seen these kinds of experiments in other countries. If the bankers were to hire you as their legal expert, what would be the most important advice you would give them in terms of structuring this bad bank? And government should be there, isn't it? It cannot be an effort without the government, right?
Absolutely. So I have a slightly different take from some of the other examples. So I think this should be set up as a public-private partnership with the government being in minority. And there are several examples of institutions like this in India itself. For example, NIIF, where the government is less than 50%. Because I think one of the most critical decisions that you have to take here is, in the structure, is to give this entity commercial freedom to function in a manner that is commercially savvy to maximize recovery. We already talked of a time limit. So these kind of funds or ARCs usually have a time limit of 5 years or 7 years or whatever it is. Some of them tend to overshoot the time limit, but at least there is a time limit, so they need to be able to function with speed. I think there are three parts of this: the ownership structure, the governance structure, and then the process that is followed to ensure that the transactions that are done in a transparent, fair, and non-corrupt manner. And there are two transactions. One is when the bank offloads the loans to the bad bank, and secondly, when the bad bank resolves them in some form or the other, one of which will be potentially IBC. So let's take each one of them. I think the ownership structure, the right answer is public-private partnership, and the private part can comprise of a number of entities, which could include some of the banks that are selling the loans, and it could include perhaps international investors who have stressed fund expertise as well. Not the vulture funds probably, but there's a whole lot of a slew of investors who would be able to bring expertise. So that's the ownership part.
Okay.
As far as the governance part is concerned, it should be, I think, as both the other speakers have also said, it should be manned by professionals who have special expertise in resolving this. And then coming to the asset resolution first, and when the assets are bought from the banks, I think that can be a little prescriptive to ensure that it's, say, done at book value. It could be done on a 1585 structure or some similar modification that can be evolved so as to make it fast without any slowdown, not necessarily an auction.
Okay.
And when the assets start to be resolved, there can be number of IBC could be there, pre-IBC, RBI circular. There's a whole toolkit.
Okay.
Key thing is to allow the bad bank to use that toolkit flexibly.
Okay. Okay, actually, Ananth was raising his finger, so I think you want to make a point, Ananth. But before that, I also have a question for you. Does this mean money from the government? Because that's not there. We don't have too much of it.
So very quickly, Latha, Cyril made excellent points, and I endorse all of them. My only concern on this public-private partnership structure, we've tried this in the past with this, Sashakta, Samadhan, and all those stuff. The point is the size of the NPA is enormous.
Yes.
As we discussed earlier, it's 12 to 14 trillion rupees. And if by some estimates, it could go to 18 to 20% of advances by the end of COVID-19, which would be unimaginable 25 trillion rupee plus kind of sizes. Now, if you want, private money to come in, will it come in the right time to handle these kind of enormous sizes is a question mark. The reason why Malaysia went for a completely public kind of an entity, even though it was entirely professionally managed, was precisely this. Getting private money of this size quickly can be a problem. The second question was, how does the government fund it? Now, look, the government has already been issuing, recapitalizing banks. 3.6 lakh crores or something has been done over the last 3 years. How did it do it? It's outside of the fisc. It issued recap bonds, which were taken up by the same banks which got the capital. So effectively, it became a book entry on the books of the bank. You have a bond, a government bond on the asset side, and you have capital coming in from the government for the same amount. But it's a risk transformation. You get equity on one side against holding government assets. So it was essentially self-funded in many ways and outside of the fiscal, right? The same method can be used in this case as well, which is essentially using recap bonds to infuse equity to the bad bank.
All right. Okay. So pay through recap bonds. Got that. Well, actually, Bahram, Ananth and Cyril have hinted to the other issue, legal tangles. I mean, look at the way the IBC got smothered down because of, everyone going to the court to challenge something or the other. Do you think, this could face the same fate? I mean, somehow I'm a little disappointed at the way in which the entire legal process has gone on in IBC. Earlier, when we solved problems, say we had UTI, we had Satyam, you had one big person whom you trusted. It was either Mr. Damodaran or Mr. Deepak Parekh and Achyutan in the Satyam affair. But IL&FS, we have a marquee banker handling it, but he's weighed down. I'm just worried whether the legal and the other bureaucratic processes can weigh down this institution, even before it's born.
So do you want me to respond?
I think
I was asking Bahram. Anyway, go ahead, Bahram.
Yeah, I think Latha, I mean, that's always a risk. And yesterday, as chairman of SBI mentioned, there will be some dispensation of regs also required, because they've got caps on holding both at the AMC and in the fund structure under the BR Act. So I think that there will have to be some dispensations made. But as Cyril said, as long as the two transactions, the first transaction across from the banks to the fund is done in a sensible, transparent way. Yes, I understand auction may be too time-consuming and messy, and then again you get into these kind of legal hassles. But it has to be done, look at the best model that suits us, and then have very tight framework, so that there can be no monkey business in this. And the second one, actually, again, as long as the AMC is run by strong professionals, I think the second one should run pretty smoothly. And again, I would go for the 5 years, because I think whenever you give too long a time, especially for us, it's a dangerous thing. And we've known most of these problems already for the last 5 years.
Yep.
So I would go with the 5 years for sure.
Okay. No, my big fear is that if we can find someone whom everyone trusts, the AMC professional needs to be like, no one questioned Deepak Parekh and Achyutan and company when they did the Satyam transaction. No one questioned Damodaran when he did the UTI, structured the UTI transaction. I wish we can find people who are above board. Otherwise, we seem to be doubting everyone these days. Cyril, Shroff, we spoke about these verticals. Like power would be a very good example, as Bahram said. Do you think that we should not attempt too much? Ananth is speaking about 10 trillion. Maybe we start only with a few assets. I mean, suppose you start taking NBFCs as well. Maybe we should first start small.
Yeah, I don't think it's a question of small or big, because I think this structure, this bad bank structure, will essentially have a central ARC or an AMC, and then it can create many pools of capital as sub-trusts with reference to specific industry verticals. So I think the problem, even before COVID, was quite severe in several verticals, including power, and probably a whole lot of new ones have just got added because of sectors which have been disproportionately affected by the COVID crisis and social distancing and all of that. So I think we should not miss the moment. And if there is value still left in certain sectors, it's better to bring in private capital, which has the expertise and the ability to deal with this. So I think we should go for a big bang. I don't think we should try small. And I am in favor of a public-private partnership. If we make it fully public, I think the very risk that you mentioned of excessive scrutiny and PILs and governance issues and all of that, I think we are setting ourselves up for failure. If a bad bank has to function in India, it can't be completely private, it can't be completely public, it has to be a public-private partnership with commercial flexibility. And once you have that, I would say go for the big one. Don't try small experiments.
Okay, well, you know what? Off the camera, let's sit and draw up a bad bank. And the next time we all meet, we can discuss on which is the best structure to go ahead. I know I've borrowed a lot of time from your individual commitments. Thank you very much, Ananth Narayan, Bahram Vakil, and Cyril Shroff for joining us. The bankers are going to be very happy. Top experts in the country believe that what they have begun in the form of thinking about a bad bank is a good idea, and starting a good idea is half the work done, I would think. Let's hope we will be able to clear the backlog of bad assets quickly. That's it on this edition of Indianomics. Thank you very much for watching.